you're now at a crossroad where it's like, okay, does the U.S. want to stay the military hegemon? Yes or no? If you think yes, then the U.S. has to reindustrialize. Then the decision is you need a weaker dollar to do it. You cannot reindustrialize the U.S. without a weaker dollar. And I think this is really what we're going to end up with, almost regardless of who is elected between Biden or Trump. I think it'll be much faster with Trump. I think Trump inherently knows this. Trump wants a weak currency. You hear Lighthizer, his main economic advisor, talk about it all the time. He himself says that the dollar is too high. So I think if Trump gets elected, you very quickly get policies put in place to weaken the dollar and try to reindustrialize.
You're watching Silver News Daily. Subscribe for more. Did you know silver prices are poised to skyrocket in the near future? It sounds unbelievable, but renowned market analyst Louis-Vincent has broken down the silver market and identified the key factors that could lead to a massive rally. In today's video, we'll explore his insights and reveal why silver might be the best investment you can make right now. Stay tuned to learn how these market dynamics could impact your financial future.
I've talked a lot about this, but the way you have to conceptualize currency systems for me is the same thing as an operating system for a computer. Today, the US dollar is the Microsoft of the world. It's the Microsoft of the world in that, most people use it because everybody else uses it. The reason I use Microsoft in my business is that when we hire somebody new, we can assume they know how to they use Excel, we can assume they know PowerPoint, all these things. Mm-hmm. And this is what the US dollar is. It is the Microsoft of the system. Now, having said this, Microsoft has been, of course, the behemoth of the software world, but you've got other software companies that can provide great services. And some of them over the past 10 years have grown much faster than Microsoft. Even if Microsoft has done great, others have done even better. Apple comes to mind, of course. You look at Apple over the past 15 years, it's grown by leaps and bounds. And it's grown by leaps and bounds by creating a separate operating system on a different platform. It's created the smartphone, created the iPad, and basically broke away from the sort of monopoly that Microsoft had over operating systems in general. And this is what the renminbi, of course, is trying to do. And it's doing it very, very gradually. And so I always say this: de-dollarization. It's not a date. It's not it's not like water going from water to ice at a certain temperature. It's just a slow, gradual process. And yes, to your point, I think in BRICS you are seeing incremental other currencies being used for settlements. We've moved 5 years ago from 100% of global oil being traded in US dollars to now only 80% of global oil being traded in US dollars. Big question is, where will we be in 10 years' time? Will we still be at 80%? I definitely don't think we'll be back at 100%. So will we be at 80? We'll be at 70, at 60? Probably the right number will be somewhere around 70 or 60% of global oil being traded in US dollar and the rest in other currencies. So it's slowly happening, and that presents a lot of opportunities elsewhere.
Silver prices have been on a roller coaster ride lately, with significant fluctuations capturing the attention of investors worldwide. As of now, the market is witnessing a mix of cautious optimism and speculative fervor. Just recently, silver experienced a solid bull run from March to May 2024, nearly reaching its first bullish target of $34.70. However, this rally stalled, leaving many wondering what's next for the precious metal. Several factors contributed to this recent price movement. Elevated U.S. Treasury bond yields and hawkish commentary from the Federal Reserve have exerted downward pressure on silver, causing its price to edge lower. As a result, silver currently trades around $29.49, down 0.38% from its recent peak. This price drop highlights the market's sensitivity to broader economic conditions and monetary policy signals. Amid this backdrop, market sentiment remains mixed. While some investors are cautious due to potential interest rate hikes and their impact on the economy, others see this as a temporary dip, presenting a buying opportunity. Understanding the current state of the silver market is crucial as we delve deeper into the factors that could propel silver prices to new heights.
Well, let me just start off by saying, when you look at China selling treasuries, I think it's hard to blame China. If you go back to 2 years ago, a little over 2 years ago, all Western countries seized all of Russia's assets that were held abroad. And as we did this, I say the Western world, literally pointed to China and said, "You're next." If you don't do exactly what you're told, you're next. So imagine you're holding a bunch of U.S. treasuries and you're told, we just confiscated your best friend's money and we're coming for you next. You'd be thinking, do I want to keep a hold of this? And I think the answer is pretty obvious, right? The answer is no. And to your point, it's like, okay, what do I buy? Well, if I buy a bunch of gold and I bring it back at home, I always have this and nobody can take it away from me. Which is, of course, always the main argument for gold in the first place, is that it's nobody's liability. It's, you hold a gold bar, it's yours. It's what JP Morgan said, gold is money, the rest is credit. So yeah, China's going down this path, I think partly because we told them to go down this path. Now, beyond that, your second question on de-dollarization is a very important one. Is China doing this out of fear? Because China's gold buying has really ramped up in the past couple of years. Is it doing this out of fear, or is it doing this out of a grander design of, going to places like Indonesia, going to places like South Korea and saying, look, instead of trading in dollars, let's trade in renminbi. And if you don't want to keep renminbi bonds, if you don't know what to do with these renminbi, now, ideally, I give you renminbi for your nickel. Let's say if you're Indonesia, I buy your nickel, and you buy my cars, you buy my earth moving equipment, you buy my telecom switches or my solar panels. But if you still have renminbi leftovers, then ideally you buy my Chinese government bonds. But if you don't feel comfortable doing that, yes, I have a Shanghai gold exchange where you can trade your renminbi for gold. So you could argue there's really two reasons China could be buying gold to the extent that it has, and it's been doing it a lot. One of them is fear following the Russia sanctions. The other is this desire to de-dollarize EM trade. To be honest, we could debate all day which it is. At the end of the day, it doesn't matter. They're selling treasuries, they're buying gold. And, the reasons for it, it's like, yeah, it's a nice debate. It's interesting. It's intellectually stimulating. But the trend remains this. And as China sells treasuries and buys gold, what do you see? You see treasury prices go down, and you see prices gold, and you see the price of gold go up. So I don't think you need to overthink it. That's the trend. We can debate the reasons, but at the end of the day, we're here to make money. And the trend is there.
Historically, silver has experienced significant rallies, often driven by a combination of economic uncertainty and industrial demand. One of the most notable examples is the 2011 silver rally, where prices soared to nearly $50 per ounce. This surge was fueled by a mix of factors including inflation fears, a weak U.S. dollar, and strong demand from both investors and industrial users. Looking back further, we see that silver's performance during periods of economic turmoil and market instability has often been robust. During the financial crisis of 2008, for instance, silver prices increased as investors sought safe haven assets. This trend underscores silver's dual role as both an industrial metal and a store of value. Understanding these historical trends is essential because they provide context for current market dynamics. Silver's past rallies were often triggered by a convergence of economic factors, making it crucial to analyze how today's economic environment compares to those previous periods. By examining the historical performance of silver, we can gain valuable insights into what might drive the next big rally and why experts like Louis-Vincent are optimistic about silver's future prospects.
The U.S. has had a brutal wake-up call with the Ukraine war. The U.S. first and foremost sees itself as the world military hegemon, right? It's the one superpower that there is in the world. When Russia invaded Ukraine, I think the perception in the West, if you remember back then, the talk was Russia as a gas station masquerading as a country. We're gonna roll up Russia. And you go back to the immediate weeks following the invasion, it's like, the Russian regime's gonna crumble. Economically, we're gonna have them on their knees in no time. So we put in the sanctions.
The ruble will become rubble.
Sorry.
The ruble will become rubble.
The ruble will become rubble, and we're just going to crush these guys. And what we find out 2 years later, to I think the dismay, frankly, of the U.S. military-industrial complex, is that Russia today alone, forget China, Russia alone is outproducing the US in terms of tank production, in terms of artillery shell production, in terms of missiles, in terms of cannons. And so we want to help Ukraine, but what we find out is we've given Ukraine all of our weapons and we can't produce them fast enough. We can't produce them fast enough because we've deindustrialized, which does leave you with all of a sudden, I think if you're the US military industrial complex, you wonder, hold on, can we be the military superpower and not have an industry behind us? It's it's what Napoleon used to say: amateurs talk strategy, professionals talk logistics. And the logistics of war is first and foremost the production of weapons. I mean, that's why the Western world won World War II, because the US could massively outproduce Japan and Germany together. The US was already the world's industrial superpower then. So what we've all of a sudden realized is by deindustrializing, staying the world's hegemon it's not possible. So that leaves you, if you're in Washington today, with a simple choice: is okay, we're no longer the world's military superpower. We're no longer the world's hegemon, and we have to adapt to that. Option one. Or option two, we have to reindustrialize. Now, if you're like me and you believe that at the end of the day, whether you vote for the Republicans or the Democrats, you end up with the same U.S. military industrial complex in power in Washington.
Economic factors play a pivotal role in shaping the trajectory of silver prices, and understanding these elements is essential to grasp why a potential rally might be on the horizon. Let's delve into the primary economic drivers that influence silver prices: inflation, interest rates, and geopolitical tensions. Inflation is one of the most significant factors affecting the price of silver. As a tangible asset, silver is often seen as a hedge against inflation. When the value of fiat currencies declines due to rising inflation, investors tend to flock to precious metals like silver to preserve their purchasing power. This behavior was evident in the 1970s during the period of stagflation, where high inflation combined with stagnant economic growth led to a substantial increase in silver prices. In recent times, inflation has become a central concern for both investors and policymakers. The COVID-19 pandemic disrupted global supply chains, leading to shortages and driving up prices for goods and services. Furthermore, unprecedented fiscal and monetary stimulus measures injected trillions of dollars into the economy, stoking inflationary pressures. As a result, the Consumer Price Index, CPI, and other inflation metrics have been trending upwards, creating a favorable environment for silver as an inflation hedge. Interest rates, set by central banks like the Federal Reserve, are another crucial factor influencing silver prices. Generally, there is an inverse relationship between interest rates and silver prices. When interest rates are low, the opportunity cost of holding non-yielding assets like silver decreases, making it more attractive to investors. Conversely, when interest rates rise, the cost of holding silver increases, as investors can earn higher returns from interest-bearing assets like bonds. Currently, the Federal Reserve has adopted a more hawkish stance, signaling potential interest rate hikes to combat rising inflation. This shift in monetary policy can put downward pressure on silver prices in the short term. However, the market's reaction to interest rate changes is not always straightforward. For instance, if higher interest rates lead to a slowdown in economic growth or trigger financial market instability, silver could benefit as a safe haven asset. Thus, the interplay between interest rates and silver prices is complex and multifaceted. Geopolitical tensions also significantly impact silver prices. During times of political and economic uncertainty, investors seek refuge in safe haven assets, including silver. Historical events, such as wars, political upheavals, and international conflicts, have often led to spikes in silver prices. For example, the Iranian Revolution and subsequent hostage crisis in the late 1970s caused a surge in silver prices due to fears of oil supply disruptions and broader geopolitical instability. In the current global landscape, several geopolitical factors could influence silver prices. Tensions between major powers like the United States and China, ongoing conflicts in the Middle East, and the repercussions of the Russia-Ukraine war all contribute to a climate of uncertainty. Additionally, the trend of de-dollarization, where countries seek to reduce their reliance on the US dollar, could have significant implications for the global financial system and commodity markets, including silver. The COVID-19 pandemic highlighted the vulnerabilities in global supply chains, affecting the production and distribution of many commodities, including silver. Lockdowns, labor shortages, and logistical challenges disrupted mining operations, and reduce the availability of silver.
It's not really a choice. You think we have to produce, so we have to reindustrialize. And then you get to the really big challenge. And the really big challenge is is industrializing is not that easy. It takes a generation. It's the older workers who train the younger workers. You need specialized workforces. You need entire supply chains, like this guy produces this widget that goes into this machine. That it's complicated stuff. It's not like optimizing puppy videos on the internet. It's really like it takes like skills, know-how that sometimes that are not taught at schools, that are sort of made up on the job. And Germany has that to some extent. China definitely has it. Japan has it. But to your point, I think the U.S. has lost it in the past few generations because, again, the 50-year-old, 60-year-old guy retires, and if he didn't train a new 20-year-old guy and pass on his skills, those skills die off with him. So I highlight this because, yes, the U.S. wants to reindustrialize. Now, the history of every industrialization shows that the best way to do it is protected by a very cheap currency. Like, if you have a much cheaper currency than the next guy, you can build your industry. Now, today, the U.S. has by far the world's most expensive currency. The U.S. dollar is crazy expensive. And I think most Americans don't realize that. They only realize it when they travel abroad. Like, as soon as they travel abroad, they're like, oh my God, everything's so cheap here. And the U.S. is a very expensive place. So you're now at a crossroad where it's like, okay, does the U.S. want to stay the military hegemon? Yes or no? If you think yes, then the U.S. has to reindustrialize. Then the decision is you need a weaker dollar to do it. You cannot reindustrialize the U.S. without a weaker dollar. And I think this is really what we're going to end up with, almost regardless of who is elected between Biden or Trump. I think it'll be much faster with Trump. I think Trump inherently knows this. Trump wants a weak currency. You hear Lighthizer, his main economic advisor, talk about it all the time. He himself says that the dollar is too high. So I think if Trump gets elected, you very quickly get policies put in place to weaken the dollar and try to reindustrialize America. Now, that doesn't mean it will be successful, but I think there'll definitely be an attempt to do it.
So you see a dollar devaluation coming?
Absolutely. I mean, look, you can't hope to reindustrialize without a weaker dollar. So the more you hear about the need for an industrial policy, the more you hear about the need for the U.S. to reindustrialize.
The potential for a significant rally in silver prices is underpinned by several critical factors, leading many to speculate just how high the price could go. Based on the comprehensive information provided, it's conceivable that silver could experience a substantial surge, potentially reaching new historic highs. First, consider the trend of de-dollarization. As more countries seek to reduce their reliance on the U.S. dollar, the demand for alternative assets like silver is likely to increase. This shift is not just a short-term reaction, but a strategic long-term adjustment. If this trend continues to gain momentum, it could drive substantial capital into the silver market. Given that central banks and institutional investors hold massive reserves, even a small reallocation from dollar-denominated assets to silver could have a profound impact on prices. Historically, significant rallies in silver prices have occurred during periods of economic uncertainty and high inflation. With the current global economic environment marked by unprecedented fiscal and monetary stimulus measures, inflationary pressures are mounting. This creates a fertile ground for silver to rise as investors seek to hedge against inflation. If inflation rates continue to climb, silver prices could mirror the dramatic increases seen during previous inflationary periods, potentially surpassing the $50 per ounce mark reached in 2011. Industrial demand for silver is another critical factor. The transition to renewable energy, particularly solar power, requires substantial amounts of silver. With global initiatives aimed at combating climate change and reducing carbon emissions, the demand for silver in photovoltaic cells is set to soar. As solar panel production ramps up, this could create a sustained upward pressure on silver prices. Analysts suggest that if the solar industry grows as projected, silver prices could easily breach the $50 threshold, potentially reaching $70 or even higher per ounce. Supply constraints further amplify this potential. Silver mining production has struggled to keep pace with growing industrial and investment demand. Environmental regulations and the depletion of high-grade ores have constrained supply, while new mining projects face lengthy development timelines. This supply-demand imbalance suggests that any significant increase in demand could lead to sharp price increases. If current trends continue, we could see silver prices climbing to $100 per ounce or more, driven by both industrial consumption and investment inflows. Speculative activity also plays a pivotal role in the silver market. During the historic 2011 rally, the absence of overwhelming speculative pressure allowed prices to rise steadily. Currently, as speculators exit their long positions, the market is resetting, creating an environment conducive to a new rally. Should speculative interest reignite alongside increasing industrial demand and inflation concerns, silver prices could experience a dramatic surge. Some market analysts predict that under such conditions, silver could potentially reach $150 per ounce or even higher. In conclusion, the convergence of de-dollarization, inflationary pressures, rising industrial demand, and supply constraints sets the stage for a significant rally in silver prices. While predicting exact price levels is inherently uncertain, the factors at play suggest that silver could surpass its previous highs and potentially reach unprecedented levels. Investors should stay informed and consider these dynamics when evaluating silver as part of their investment strategy. As always, while the potential for high returns exists, it is essential to balance this with a thorough understanding of the associated risks.
So to me, the idea that China needs to devalue is madness. Like, it is already super, super competitive. And we're seeing this in the tariffs that are being put in place. I mean, basically, the U.S. saying, look, we need to put a tariff on Chinese cars, on solar panels, on batteries. For this to come out, remember when the Biden administration came in a few years ago, the message was, climate change is the biggest emergency the world has ever faced, that we need to all be in this together, trust the science, climate is imploding, we're all going to die, we have 5 years to fix this, etc. So for these guys today to say, yeah, forget that, forget everything we said about climate change. We actually need to put a massive tax on electric vehicles because we don't want Americans to drive $10,000 electric vehicles. And we don't want Americans to get cheap solar panels. And we don't want Americans to get cheap batteries so that they can store their own electricity at home. We definitely don't want that. For this particular administration to say this is a massive testimony to how cheap the stuff is made in China, right? They're basically saying, forget climate change. Don't worry about this. All you need to worry about is the competitiveness of Chinese goods. So to think that at the same time China's going to devalue seems madness to me.
Well, as somebody who has offices over there in that part of the world, I really appreciate your perspective on this specific topic because there's a lot of people out there suggesting that a devaluation of their currency is going to happen. It's going to happen imminently. And so I really appreciate that. So,
well, look, so on this, I'll just add two more things. I really don't think, for all the reasons I just highlighted, it's going to happen. But China would definitely not do it before the U.S. election. It would be madness for them to do. It's a political decision either way, right? They've got capital controls. They fix the price. For them to do it before the U.S. election, when really it could be, if you're China today, you're hearing Trump saying, I'm going to put 60% tariffs on all Chinese goods. So first you wait till Trump comes in. And then if he comes in, you say, well, look, if you put in a 60% tariffs, we devalue 50% to leave us, where we were. So you're not going to shoot that arrow before Trump comes in. Now, I still don't think they do it, but they definitely don't do it before the election.
One of the most intriguing aspects influencing the silver market today is the trend towards de-dollarization. This term refers to the process by which countries reduce their reliance on the U.S. dollar in international trade and finance. Historically, the U.S. dollar has dominated global markets, serving as the primary reserve currency, the main medium of exchange, and the standard unit of account. However, growing discontent with this dominance has led to more countries exploring alternatives to the dollar. Recent years have seen a marked increase in these de-dollarization efforts, driven by a desire to mitigate the risks associated with over-reliance on the U.S. dollar. This trend is particularly pronounced in regions like Southeast Asia, the Middle East, and Latin America. Countries in these areas are seeking to diversify their foreign exchange reserves and trade invoicing methods, moving away from the dollar and toward other currencies and assets, including gold and digital currencies. The economic rationale behind de-dollarization is multifaceted. One of the primary concerns is the asymmetry between the U.S. economic weight in the world and the dominant role of the dollar. Despite the U.S.'s shrinking share of global GDP and trade, the dollar's dominance has grown, leading to a fragile global financial system heavily influenced by U.S. monetary policy. This concentration of power is seen as unsustainable and has sparked fears about global financial stability. Another significant factor driving de-dollarization is the perception that the U.S. has weaponized its currency to advance foreign policy objectives. Sanctions imposed on countries like Russia have highlighted the potential risks of holding dollar-denominated assets, prompting affected nations to seek alternatives to mitigate their exposure to U.S. economic sanctions. This shift away from the dollar has important implications for the silver market. As countries diversify their reserves and reduce their dependency on the dollar, they often turn to tangible assets like gold and silver. Central banks, particularly in emerging markets, have been increasing their gold purchases as part of this diversification strategy. This trend has also contributed to the rising demand for silver, as it is often used in conjunction with gold for monetary and investment purposes. Additionally, de-dollarization efforts have led to a broader revaluation of global trade practices. More countries are opting to settle international transactions in their local currencies or through barter agreements. This move reduces the demand for dollars and can lead to increased volatility in foreign exchange markets, further boosting the appeal of silver and other precious metals as staple stores of value. The push for de-dollarization also aligns with the broader geopolitical shift towards a multipolar world. As major economies like China, Russia, and India pursue policies to enhance their financial independence, the global economic landscape is becoming more fragmented. This fragmentation increases uncertainty and can drive investors towards safe haven assets like silver. The rise of central bank digital currencies, CBDCs, is another aspect of de-dollarization that could impact silver prices. Many countries are developing their own digital currencies to facilitate faster and more secure cross-border transactions. While the primary goal of these digital currencies is to modernize financial systems, they also represent an effort to reduce reliance on the dollar-dominated financial infrastructure. As these digital currencies gain traction, they could further diminish the dollar's dominance, enhancing the attractiveness of silver as an alternative asset. Overall, the trend towards de-dollarization reflects a significant shift in the global economic order. While the dollar is unlikely to lose its status as the world's primary reserve currency overnight, the increasing momentum towards diversification and financial independence among major economies is reshaping the market dynamics. For silver, this shift presents both challenges and opportunities. As countries and investors seek alternatives to the dollar, silver stands to benefit as a valuable component of a diversified reserve portfolio. This potential increase in demand could be a crucial factor driving the next big rally in silver prices, making it an exciting time for silver investors to stay informed and engage with these global economic trends.
Code word for it's a polite way to say we need to devalue.
Okay. So, Louis, speaking of devaluation, currency devaluation, there's been a lot of chatter around the world's number 2 economy, China, devaluing their currency, the renminbi. So do you expect a devaluation to happen there? And if they do devalue their currency, what would the knock-on effects be of that kind of move to the U.S. consumer, the economy, and the dollar?
So let me say this. I think like all the talk of all the people who run around saying China needs to devalue, are people who've either never traveled to China or who haven't traveled there in the past 5 to 6 years. I think if you travel in China today, you are awestruck at how cheap everything is. So let me just give you a few examples. Like today, you want to go to New York, you want to stay at the Four Seasons Hotel in New York, it's going to cost you $1,500. You want to stay at the Four Seasons in London or in Paris, it's going to cost you $2,000. You want to stay at the Four Seasons in Shanghai or Beijing, it's going to cost you $200. So that's, you want to take a train from New York to Chicago. That's going to be a 21-hour train, and it's going to cost you $200. Now, same distance. It's actually a bit bigger, but almost. It's New York, Chicago is 780 miles. Beijing, Shanghai is 850 miles. Beijing, Shanghai, 850 miles, 5-hour train ride, $80. So, you want to buy a car. Cheapest electric car in the U.S. is the Nissan Leaf, $30,000. Cheapest electric car in Germany is the Dacia Spring. It's 25,000 euros. What's the cheapest car in China? You take the BYD Seagull, $9,000. Smartphone costs. You take the Huawei Pulse or the Xiaomi 14. I think, bigger screens, much better, more storage than an Apple iPhone, and it's basically roughly 60% of the price of the Apple iPhone. Like, anything in China is so much cheaper that you go there and you're like, what is the hotel, is the Four Seasons in Shanghai supposed to be $100 a night? Like, how much cheaper do you want this? So, and this cheapness is, of course, reflected in China's trade data. China today is running trade surpluses of 70 billion a month. Now, put things in perspective. This is bigger than the German and Japanese trade surplus at their peaks put together. Never in the history of the world has a country run trade surplus of 70 billion a month.
The dynamics of supply and demand play a crucial role in determining silver prices. Unlike gold, silver has extensive industrial applications, which means its demand is influenced not only by investment and monetary considerations, but also by its use in various industries. As we delve deeper into the supply and demand aspects, it becomes clear how these factors could contribute to a significant rally in silver prices. Silver is indispensable in several key industries, including electronics, solar energy, and medical devices. Its unique properties, such as high electrical conductivity and thermal conductivity, make it an essential component in manufacturing a wide range of products. The growth of these industries directly impacts the demand for silver. For instance, the expansion of the electronics industry, driven by advancements in technology and the increasing use of electronic devices, continues to boost the demand for silver. Similarly, the push towards renewable energy sources, particularly solar energy, has led to a surge in the use of silver in photovoltaic cells. The demand for silver in the solar industry is particularly noteworthy. Solar panels, which convert sunlight into electricity, rely heavily on silver for their efficiency. As the world shifts towards greener energy solutions to combat climate change, the demand for solar panels is expected to grow exponentially. This growth will likely drive up the demand for silver, creating upward pressure on its prices. On the supply side, silver mining is a complex and capital-intensive process. The majority of silver is produced as a byproduct of mining other metals such as gold, copper, and zinc. This means that silver production is often influenced by the market conditions of these primary metals. When prices of primary metals are low, mining activities slow down, leading to a reduced supply of silver. Additionally, environmental regulations and the depletion of high-grade silver mines further constrain the supply. These factors contribute to a tighter supply scenario, which can drive prices higher when demand increases. Recent trends have shown that silver mining production has not kept pace with the rising industrial demand. This supply-demand imbalance is a key factor that could trigger a substantial rally in silver prices. As industrial applications continue to grow, the pressure on supply will intensify, potentially leading to significant price increases. Moreover, the silver market is also influenced by recycling and above-ground stockpiles. While recycling can provide a supplementary source of silver, it is not sufficient to meet the burgeoning demand from industrial applications. Above-ground stockpiles, which include silver held by investors and governments, can act as a buffer to absorb short-term supply shocks. However, if these stockpiles are drawn down too quickly to meet demand, the market could experience further supply constraints, pushing prices higher. Investor demand is another critical aspect of the silver market. Economic uncertainty, geopolitical tensions, and concerns over currency stability drive investors towards precious metals like silver as safe haven assets. This investment demand can create additional pressure on supply, especially during times of economic instability. When investors flock to silver as a hedge against inflation or currency devaluation, it can lead to substantial price increases. The trend of de-dollarization, as previously discussed, also intersects with supply and demand dynamics. As countries and investors seek alternatives to the US dollar, the demand for tangible assets like silver is likely to increase. This shift can amplify the demand side of the equation, further straining the already tight supply and driving prices higher. In conclusion, the supply and demand dynamics of silver are influenced by a multitude of factors, including industrial applications, mining production, recycling, investor demand, and geopolitical trends. The growing demand from key industries, coupled with constrained supply, sets the stage for a potential significant rally in silver prices. As these factors continue to evolve, the silver market remains poised for substantial gains, making it an attractive investment opportunity for those looking to capitalize on these market dynamics.
the second question is much easier. Yes, we are in the midst of a protectionist trade war. And look, I think the question of tariffs is one of those that neatly divide opinion. But the bottom line is tariffs make for higher prices for consumer. Now, the reality is that a lot of countries over the years have developed under the shelter of tariffs. You've seen this across, in Japan, they use tariffs to grow their industry. In South Korea, they use tariffs to grow their industry. And in China, they've done the same. So tariffs, as part of, I would say, a broader industrial policy and an economic plan, can sometimes spontaneously make sense. But let's not kid ourselves that fundamentally tariffs are protecting producers to the detriment of the consumer. Now, the US economy happens to be 70% consumption. So what you're saying when you're putting in tariffs is you're saying we're going to penalize our 70% of our GDP to grow. I think U.S. industry today is like 7 or 8% of GDP because we need to grow this. Now, this is a political choice, and perhaps that's fine. Now, I would say that if tariffs are part of a greater plan, then they can potentially work economically over the long term. If tariff is the plan, if all we're doing is throwing tariffs for political reasons to look good, to win some votes in Michigan and Wisconsin, then actually economically they make little sense. So, when you look at the U.S. tariffs, I would say here's the question is, do you think that's part of a bigger plan to reindustrialize the U.S., or do you think it's just political posturing? If it's just political posturing, it's just going to end up costing the consumer money for no long-term benefit.
Speculative activity in the silver market plays a significant role in price volatility and overall market dynamics. Understanding how speculators influence the silver market helps us grasp the potential for future price movements and the factors that could drive a significant rally. Speculators, including hedge funds and individual traders, often enter the silver market seeking short-term profits from price fluctuations. Their trading activities can create substantial price swings, as seen during the bull run from March to May 2024. During this period, a surge of speculative interest pushed silver prices towards their bullish target of $34.70. However, as the market became saturated with long positions, the rally stalled, highlighting the impact of consensus trades. Consensus trades occur when a majority of market participants hold similar positions, either long or short. In the case of silver, the market witnessed an excessive number of speculators betting on the long side, which ultimately prevented prices from moving higher. Markets tend to correct when too many participants are positioned in one direction, leading to price reversals and increased volatility. The role of speculative activity is further emphasized by historical precedents. For instance, during the historic 2011 silver rally, there was no consensus long setup among speculators, allowing prices to rise more sustainably. This absence of overwhelming speculative pressure enabled silver to reach nearly $50 per ounce, driven by genuine demand from both investors and industrial users. In recent months, there has been a notable shift in speculative activity within the silver market. Speculators have started to exit their long positions, driven by market corrections and the realization that consensus trades rarely end well. This development is crucial for the future trajectory of silver prices. As speculators give up their long positions, it creates an environment where the market can reset and prepare for the next potential rally. The departure of speculators from the silver market is a promising sign for those anticipating a future price surge. With fewer speculative positions, the market is less likely to experience sudden, sharp corrections, allowing for a more stable and sustained price increase. This phenomenon aligns with the classic market dynamic where speculators often exit just before a significant upward movement. Additionally, the broader economic environment and market sentiment play a role in shaping speculative activity. Factors such as inflation fears, interest rate expectations, and geopolitical uncertainties influence traders' decisions to enter or exit the silver market. As these macroeconomic conditions evolve, they will continue to impact speculative behavior and, consequently, silver prices. It's important to consider that speculative activity is not inherently negative for the market. While it can lead to increased volatility, it also provides liquidity and can amplify price movements in both directions. Savvy investors can take advantage of these fluctuations by timing their entries and exits based on market signals and trends. Furthermore, the current economic backdrop, characterized by high inflation and potential interest rate hikes, provides a fertile ground for speculative interest in silver. As investors seek to hedge against economic instability and currency devaluation, silver's appeal as a safe haven asset grows. This increasing interest can drive speculative activity, contributing to higher prices in the near future. In summary, speculative activity is a double-edged sword in the silver market, capable of driving both volatility and significant price movements. The recent reduction in speculative long positions sets the stage for a potential rally as the market resets and prepares for a new wave of interest. Understanding the interplay between speculators and market dynamics is crucial for anticipating future price trends and recognizing opportunities for investment in silver. As we continue to explore the factors influencing silver prices, it becomes evident that speculative activity will remain a key component of the market's behavior and potential for growth.
The biggest opportunity, of course, for me out of this trend is in emerging market debt. And this is something that people haven't looked at. But, so far this decade, whether you take the debt of Brazil, of India, of Indonesia, of China, of Mexico, i.e. the big emerging markets, all of their debt, the returns are absolutely crushing US dollar treasuries. Not by a little, but I'm not talking 5% outperformance. I'm talking outperformance of 30, 50, 100% between US treasuries in just the past 4 years, between the debt markets. And what's fascinating is this is occurring against a backdrop where China hasn't been very strong. It's occurring against a backdrop where you've had a massive EM crisis with Russia invading Ukraine. And it's occurring against a backdrop where the Fed has tightened monetary policy aggressively. Now, historically, each time the Fed tightened, EM debt would puke. But now EM debt, again, it's not like outperforming US treasuries by little. It's just absolutely crushing it. So it's the de-dollarization is gradually happening, and the beneficiary of it is EM currencies and EM debt.
To gain deeper insights into the silver market's potential for a substantial rally, we turn to expert analyses and predictions, particularly those of renowned market analyst Louis-Vincent gave. His comprehensive breakdown of the silver market and identification of key drivers provides a valuable perspective on why silver might be poised for significant gains. Louis-Vincent Gave's expertise in global economics and financial markets lends considerable weight to his predictions. According to Gave, several interconnected factors could lead to a bullish scenario for silver. One of the primary drivers he highlights is the ongoing trend of de-dollarization. As more countries and investors seek alternatives to the US dollar, the demand for tangible assets like silver is likely to increase. This shift away from dollar-denominated assets is driven by both geopolitical tensions and economic pragmatism, as nations aim to reduce their exposure to U.S. economic policies and potential sanctions. Gabe also points to the impact of monetary and fiscal policies on silver prices. The extensive monetary easing and fiscal stimulus measures implemented by governments worldwide in response to the COVID-19 pandemic have led to significant liquidity in the financial system. This excess liquidity often finds its way into commodity markets, including silver, as investors seek to hedge against inflation and currency devaluation. The result is increased investment demand for silver, which supports higher prices. Another crucial factor discussed by Gabe is the role of central banks in the silver market. Central banks, particularly in emerging markets, have been diversifying their reserves by increasing their holdings of gold and, to a lesser extent, silver. This trend is part of a broader strategy to reduce reliance on the US dollar and enhance financial stability. As central banks continue to build their precious metal reserves, the demand for silver is expected to rise, contributing to its bullish outlook. In addition to these macroeconomic factors, Gabe emphasizes the importance of industrial demand in driving silver prices. The ongoing technological advancements and the global push towards renewable energy sources, such as solar power, have significantly boosted the industrial use of silver. Photovoltaic cells and solar panels, for example, rely heavily on silver for their efficiency. As the adoption of solar energy accelerates, so does the demand for silver, creating upward pressure on prices. Gabe's analysis also considers the current supply dynamics in the silver market. Silver mining production has not kept pace with rising industrial demand, leading to a tighter supply scenario. Environmental regulations, declining ore grades, and the capital-intensive nature of mining further constrain supply. These supply limitations, coupled with robust demand, set the stage for potential price increases. Moreover, Gabe highlights the impact of speculative activity on silver prices. While speculation can lead to short-term volatility, it also has the potential to drive significant price movements. As speculators exit their long positions, as seen in recent market corrections, the stage is set for a more stable and sustained rally. This reset in speculative activity aligns with historical patterns, where major price surges often follow periods of reduced speculative interest. In conclusion, Louis-Vincent Gabe's insights into the silver market underscore the convergence of several critical factors that could drive a substantial rally in silver prices. De-dollarization efforts, monetary and fiscal policies, central bank reserves, industrial demand, supply constraints, and speculative activity all play integral roles in shaping the market's outlook. By understanding and analyzing these elements, investors can better anticipate potential price movements and position themselves to benefit from the expected silver rally. Gabe's expert analysis provides a comprehensive framework for navigating the complexities of the silver market and underscores the potential for significant gains in the near future.
But I like the fact that you talk war, because
No, please.
What you have to remember is that this generation of Chinese leader, and Xi Jinping especially, they grew up during the Cultural Revolution. They were packed off to go to the countryside to till the earth with their bare hands. For those listeners of yours who haven't read about the Cultural Revolution, it was a very, very dark time in China's history. This generation went through an extremely, extremely dark time, and they were shipped off to the countryside with the only book to read for basically 5 years that they could read was Chairman Mao's Little Red Book, and that's all they had to read. Now, Chairman Mao's Little Red Book is really a book on how to conduct guerrilla warfare. You read it, it's all about his thoughts about how to do guerrilla warfare. And his number one advice is, when your enemy picks a battlefield, you attack him somewhere else. So if the U.S. decides to pick the battlefield of tariffs, China isn't going to respond to the battlefields of tariffs. They're going to respond somewhere else, which goes back to the point you just started with. What is China doing today? It's selling bonds, buying gold. Selling bonds, buying gold. So the U.S. decides to attack here, we attack over there.
The overuse of economic sanctions by the U.S. government has played a significant role in triggering mass sell-offs of the dollar in favor of assets like silver, particularly among key geopolitical rivals such as China and Russia. This shift is driven by a combination of economic pragmatism and strategic maneuvering, as these countries seek to insulate themselves from the financial weaponization of the dollar. Economic sanctions have long been a tool of U.S. foreign policy, aimed at exerting pressure on nations that oppose its geopolitical interests. However, the extensive and frequent use of these sanctions has led to unintended consequences, notably pushing targeted countries to seek alternatives to the dollar-dominated financial system. The sanctions imposed on Russia following its actions in Ukraine and other geopolitical disputes have been particularly influential. These sanctions included freezing Russian assets held abroad and cutting off access to international financial systems like SWIFT. Such measures highlighted the risks associated with holding dollar-denominated assets, as they can be rendered inaccessible by U.S. policy decisions. For countries like China and Russia, the possibility of being subjected to similar sanctions has prompted a strategic reassessment of their financial reserves and trade practices. Holding large amounts of U.S. dollars exposes these nations to potential economic disruption if their assets are frozen or their access to global financial markets is restricted. As a result, both countries have accelerated efforts to diversify their reserves, moving away from the dollar and increasing their holdings of alternative assets, including gold and silver. China, for instance, has been steadily reducing its holdings of U.S. Treasury bonds, a trend that has been particularly pronounced in recent years. Instead, China has been ramping up its purchases of gold, and by extension, silver, as part of a broader strategy to diversify its reserves. This shift is not merely a reaction to immediate geopolitical tensions, but a long-term strategic move to reduce vulnerability to U.S. economic influence. By holding tangible assets like silver, which are not subject to the same political risks as dollar-denominated assets, China can better protect its financial stability. Russia's approach has been similar. In response to the sanctions imposed on it, Russia has significantly increased its gold reserves, and by proxy, its interest in silver. The move to acquire more silver is part of a broader strategy to fortify its economy against potential future sanctions. Silver, being a precious metal with intrinsic value and extensive industrial uses, provides a hedge against the volatility and risks associated with the dollar. The trend towards de-dollarization among these key geopolitical rivals is further reinforced by their collaborative efforts to establish alternative financial systems and trade mechanisms. China and Russia have been working on developing their own cross-border payment systems, reducing their reliance on U.S.-dominated infrastructures like SYFT. Additionally, both countries have been promoting the use of their own currencies in bilateral trade agreements, thereby diminishing the role of the dollar in their economic interactions. This strategic pivot away from the dollar towards silver and other tangible assets is not just about mitigating risk, it is also about asserting economic sovereignty. By reducing their exposure to the dollar, China and Russia aim to increase their financial independence and reduce the leverage that the U.S. can exert over them through economic sanctions. This move towards greater autonomy in financial matters is a critical aspect of their broader geopolitical strategies. In summary, the overuse of economic sanctions by the U.S. has triggered a significant shift among key geopolitical rivals like China and Russia. These nations are divesting from dollar-denominated assets and increasing their holdings of silver and other tangible assets to protect themselves from potential economic disruptions. This strategic realignment is driven by a desire to reduce vulnerability to U.S. influence and to assert greater economic sovereignty, highlighting the profound impact of geopolitics on global financial markets.
Sir, is it's going to depend very much on who you are. What the U.S. has done in recent years is the U.S. has come out and said, look, we're splitting the world between good democracies with whom we can be friends and everybody else. And if you're not a democracy, we think that we have big problems with you. We think that in essence, it's the white hat versus the black hats. It's, you're not a democracy. You're not part of our group. And we're liable to take financial sanctions against you at any given point. And even if you're an old friend like Saudi Arabia, we're going to say that you're not reputable, and we're going to refuse to shake your hands publicly, as Biden did early in his mandate. So if you send that message out to all the emerging markets, now most of the emerging markets tend to be, not always democracies. So you send that message to the non-democratic countries, and in essence, what you're saying is you guys should invest in U.S. treasuries, right? What you're saying is you just made U.S. Treasury holdings for these guys much more dangerous. Now, the reason they held U.S. Treasuries in the first place, of course, was to settle their trade. The reason, if you're Kenya, if you're Bangladesh, if you're Indonesia, the reason you own U.S. Treasuries is to settle, the oil you might buy, or the machine tools, or the semiconductors, or whatever else you might buy in U.S. dollars. Now, there you've had two massive changes. The first is Russia's now coming in and saying, hey, you need commodities? I'll sell them to you for your own local currency because I can't use U.S. dollars anyway. So all of a sudden, if you have no moral problems with buying stuff from Russia, and typically if you're poor, you can't afford to have moral problems. So if you're India, you're like, yeah, you know what, I'll buy it. And you're giving me oil at a discount? Sure. And you take rupees? Puh, I'll do that deal every day of the week and twice on Sunday. It's like, I'm going to do this all the time. So you've got this. And now you've got China coming in and saying, hey, you need machine tools, you need cars, you need a power plant, you need a port, you need a railway. I can provide all these things for you. And tell you what, I'll provide the credit for it as well. Yes, this will be priced in renminbi, but I'll fund it, and you can pay me back over time by selling me nickel, by selling me tin, by selling me wheat, whatever it is that you happen to be selling. And so all of a sudden, the need for U.S. Treasuries have become more dangerous, and the need for them isn't as acute as it used to be.
As we navigate the potential for significant changes in the silver market driven by geopolitical shifts, economic policies, and rising industrial demand, it's crucial for individual investors, often referred to as silver stackers, to consider how much silver they should hold to prepare for these coming events. The answer depends on several factors, including individual financial goals, risk tolerance, and overall investment strategy. First and foremost, it is essential to understand that silver, like any investment, carries inherent risks. While the potential for significant gains exists, especially in light of the factors we've discussed, investors should approach silver stacking with a well-thought-out strategy that balances potential rewards with risks. A common recommendation for precious metals allocation in a diversified investment portfolio is between 5% and 10% of total assets. This allocation helps to hedge against inflation, currency devaluation, and economic uncertainty without overexposing the investor to the volatility of the metals market. Given the current economic climate and the potential for a significant silver rally, some investors might consider leaning towards the higher end of this range, or even slightly exceeding it. depending on their confidence in the market dynamics and their financial situation. For more aggressive investors who are particularly bullish on silver, an allocation of up to 15% to 20% of their investment portfolio might be appropriate. This higher allocation reflects a stronger conviction in silver's potential to outperform other assets due to factors like de-dollarization, increasing industrial demand, and constrained supply. However, it's important to remember that higher allocations also come with increased risk, and such a strategy should be pursued with caution. The amount of silver to hold can also be guided by the investor's long-term financial goals and the role they expect silver to play in their portfolio. For those viewing silver primarily as an insurance policy against economic turmoil, a modest but steady accumulation of silver might be sufficient. This approach ensures that the investor has a safety net without committing too much capital to a single asset class. On the other hand, investors who see silver as a key component of their long-term wealth-building strategy might aim to build a more substantial position. In this case, it could be beneficial to set specific accumulation targets based on personal financial projections and market conditions. For example, aiming to acquire a certain number of ounces per year or month can help build a significant position over time, taking advantage of dollar-cost averaging to mitigate price volatility. In practical terms, the amount of silver to hold can also be influenced by storage considerations. Physical silver requires secure storage, whether it's in a home safe, a bank safe deposit box, or a professional storage facility. Each option comes with its own costs and security considerations, which should be factored into the overall investment strategy. For those holding large quantities of silver, professional storage solutions might offer the best balance of security and accessibility. Additionally, the form of silver held can impact both the ease of accumulation and future liquidity. Common forms include bullion bars, coins, and rounds. Each has its advantages. Coins are typically more recognizable and easier to sell in small quantities, while bars can offer lower premiums over the spot price. Diversifying the types of silver held can provide flexibility in both accumulation and liquidation phases. In conclusion, the amount of silver stackers should hold depends on individual financial goals, risk tolerance, and broader investment strategies. A typical allocation might range from 5% to 10% of the investment portfolio, with more bullish investors considering up to 20%. Setting clear accumulation targets, considering storage solutions, and diversifying silver forms are all essential steps in preparing for potential market shifts. By approaching silver stacking with a balanced and informed strategy, investors can position themselves to benefit from the expected dynamics in the silver market while managing the associated risks.
So then you're left, what do I do with these reserves? So you can go down the Indian path, which is what Modi's doing and why the country is going absolutely bananas, and say, you know what, I'm going to spend it on domestic infrastructure spending. I don't need to have as much savings as I used to have, because now I've got these long-term deals with Russia for the commodities I need. I've got these credit deals, in different currencies. So I can go out and spend. I've got 700 billion in reserves. I'm going to spend 150 billion a year for the next 5 years, rolling out infrastructure that my economy needs. So that's option one. So you just let go, and you just need fewer reserves than you used to. The other option, to your point, is you say, you know what, the world is still in an uncertain place. I still need to keep reserves. U.S. treasuries aren't as safe as they used to be. What's the next best thing? Well, yeah, you fall back on gold, right? It's liquid. It's and again, it's nobody. If you've got it in your own country, nobody can take it away from you unless you get invaded. But a lot of the countries around the world don't have to really worry about being invaded.
Bringing all these factors together, it becomes clear that the silver market is on the cusp of a potential rally, supported by a convergence of macroeconomic, industrial, and speculative forces. As we conclude our exploration, let's synthesize these insights and understand how they could lead to a significant rise in silver prices. First, the trend of de-dollarization is undeniably gaining momentum. Countries around the world are actively seeking alternatives to the US dollar, driven by geopolitical tensions, economic pragmatism, and a desire for greater financial independence. This shift is prompting central banks and investors to increase their holdings of tangible assets like silver, enhancing its appeal as a reliable store of value. As de-dollarization efforts continue to spread, the demand for silver is likely to grow, providing a robust foundation for higher prices. Second, the ongoing inflationary pressures and monetary easing policies have flooded the global economy with liquidity. Government's fiscal stimulus measures aimed at mitigating the economic impact of the COVID-19 pandemic have led to significant increases in money supply. This excess liquidity often finds its way into commodity markets, including silver, as investors seek to protect their wealth from the eroding effects of inflation. With inflation fears still prevalent, silver's role as an inflation hedge becomes increasingly attractive, driving up investment demand. Third, industrial demand for silver is poised for substantial growth. The push towards renewable energy sources, particularly solar power, is accelerating worldwide. Silver's critical role in photovoltaic cells for solar panels ensures that demand from the solar industry will continue to rise.
I mean, that's China's main goal, right? And it's been for the past 10 years. So it's undeniably happening with a lot of countries in Africa, with a lot of countries in Southeast Asia, with a lot of countries in Central Asia. Now, countries that I would say in the whole scheme of things don't move the needle very much. You know, like who cares about how Kenya settles its trade? Who cares about how Uzbekistan or Kyrgyzstan settle their trade? They're sort of, you know, minnows in the whole ocean of global trade. Now, of course, you could also argue, you know, all these minnows, it adds up after a while to something. But, you know, the big behemoths, the Europe of this world, the Saudi Arabia, that is still, you know, Europe, all of European trade, intra-European trade is no longer in dollars, right? It's all euro now. And so the de-dollarization of Europe has already happened. You know, when France trades with Germany, there are no dollars being exchanged. When now, you know, so the big behemoth in the room probably remains Saudi Arabia on this front, and there, it's hard to imagine that Saudi Arabia is going to turn away from the dollar anytime soon. Partly because, you know, Saudi Arabia depends on the U.S. for its own security, depends on the U.S. for arms sales. The Saudi family itself, the royal family, is sort of protected indirectly by the U.S. So, as long as this is the case, you know, I think that remains the Middle East remains dollar based in essence, and perhaps, you know, the recent events we've seen in the Middle East are a testimony to this, where China's done its very best to not be involved, to not come in and say, hey, we're going to help you sort this out. It's done its very best to say, you know what, not really my problem, and I don't want to get in the middle of this mess. While, you know, the U.S. is for historical reasons right in there. Let's give aid to Israel. Let's threaten Iran. Let's, you know, so that the U.S. has no quarrel. Let's put a bunch of boats in the Red Sea. The U.S. just gets stuck in. So, you know, so that's where we are.